We have approved minutes. All right. For the chair's report, there is nothing for me to report to this body at this time, so there's no motions to bring. There are no committee motions or reports that I know of, but committee chairs, please remind me if you did meet and there is something to report. Nothing comes to mind. Nothing from any of the.
Yeah, the audit meeting was.
Yeah, right. Yes. Yeah.
Did we have or did we not?
We don't have anything.
We don't. I didn't think so. Thank you. All right. So having no committee reports, no motions to be made, we're going to move now to the CEO's report. I'm going to recognize Mike Hitchcock. Please take it away.
Thank you, Mr. Chair. It's my pleasure to enter. We have some new additions to the staff, and it's my pleasure to introduce them today. So I'll take them in order. Khadijah Moultrie has joined us as our legal and compliance administrative assistant. Khadijah's sitting over here, right there in front of the window. She joined RSIC from Columbus, Georgia. She graduated from SC State University with a Bachelor of Science in Criminal Justice. She's a former paralegal and legal assistant with the Mark Casto law firm. And she has past experience with the Carl Grant law firm as well. And also has experience with the Orangeburg Magistrate Court. So welcome, Khadijah. We're excited about you joining us and look forward to great things from you. We also have Walker Dollar, who joins us as an investment associate. He's from Metter, Georgia. He graduated from Georgia Southern University in May of 2022, and he was also one of our interns while he was in school. He was a summer intern for us. He's the former executive vice president of the Southern Investment Association, and they managed $100,000 student-run investment fund. And he also has past experience with the Assurance Group and UPS. So welcome, Walker. It's great to have you.
Thank y'all. It's I'm looking forward to it, and it's nice to meet all y'all.
Welcome.
Welcome. And then finally, we have DeAndre Reed, who has joined us as a senior reporting analyst. DeAndre comes to us from Savannah, Georgia. He graduated from UNC Wilmington in 2022, where he earned his BBA, and he also earned his BBA from Savannah State University in accounting and with a minor in math. He is a former senior financial analyst with Curtis V. Cooper Primary Healthcare, and he has past experience with the Federal Healthcare Network, Amazon, and the Georgia Army National Guard. So, welcome, DeAndre.
Thank you.
All right. Just some reminders for the commission and for a few members of staff as well who fall within this. Some compliance reminders. Just to remind everyone that our statements of economic interest are due. The deadline is March 30th at noon, which is an interesting. Yeah, they're due at noon. Interestingly, it corresponds with the deadline for filing for office. So. And I believe everyone was given a code of ethics to sign and return to Michelle Latricia as well at this meeting. So please make sure that you do that acknowledgement and return that to Michelle Latricia. So that's all the administrative announcements that I have, Mr. Chair. If I can just move into, it is the time of year which we lovingly refer to as AIP SIOP season, where we begin our review of the annual investment plan as well as our statement of investment objectives and policies. You all a version, which is in the red line materials as well, but I'm going to try to just summarize the proposed changes, and then the documents are there. Both a clean copy as well as a red line copy are there for your more detailed review. As is our process, the proposed changes to the AIP SIOP are introduced at this meeting. And then should the commissioners have any additional questions, comments, items that they would like to either know more about or discuss further, or areas that they would like to see additional amendments to, I would invite everyone to get with me in the interim between now and the April the 20th meeting, And at the April 20th meeting, that's when we come back and we will actually adopt any proposed changes that the commission deems appropriate to the AIP SIOP. So really, this is our first look at the proposed changes. This is just for information purposes. Not looking for any votes or any necessarily agreement on the proposed changes today. And that's basically why we have the April 20th meeting, because we do have a statutory deadline of May 1st where we have to either it's either affirm or amend the SIOP and adopt an AIP. So just to give you kind of a high-level summary of the amendments that we proposed so far in the AIP, SIOP, I think everyone is aware that there has been pretty significant interest in our incorporation or use of environmental, social, or governance factors in our investment decision-making. And so I've attempted to insert some proposed language into the AIP SIOP that really just clarifies our position on the use of, that we really only rely on pecuniary factors, and those are the only things that we consider when making an investment decision. It has been the long-standing practice of RSIC that we make decisions based on pecuniary factors. We have never made it a practice to make investment decisions to promote any type of collateral benefit as a result of the investment, but really have always been concerned and concentrated on the risk-adjusted return that we expect to receive through the investments that we make. But in an effort to, just to make sure that that's clear and that that's clearly stated in the AIP SIOP, I have proposed some language that would enshrine that, what I consider to be that practice, into our foundational documents. So just to give you a high level review of the language, we insert a specific reference to that we make decisions in the sole interest of our beneficiaries and for the exclusive purpose of providing them benefits. That is the legal standard by which we have to, that legal standard that we have to adhere to as an expression of our fiduciary duty. That is certainly, the tone of that and the implication of that is certainly within the document as it exists. But I thought it would be, in our interest to explicitly state that in the document. So that's added in a proposed language on page 4 of the redlined document. That's what these page numbers are referring to. Also, there's some language on page 22 of the document really explicitly limiting the factors that are considered when making an investment decision to pecuniary factors. And there's a definition in that language, there's a proposed definition of what constitutes a pecuniary factor. And it's really simply any factor that would have a material impact or effect on risk or return. And then there's also a corresponding definition of non-pecuniary factor, which is the inverse, but also includes but is not limited to the consideration of environmental, social, or political factors, objectives, or outcomes. So try to explicitly clarify that that's our position on page 22. And then on page 27, providing some additional clarity and a little bit greater clarity and transparency when it comes to the exercise of proxy voting, and setting the standard for the commission that, the statutory standard is now that it has to be, the proxies have to be exercised in the best interest of the trust and to maximize shareholder value. That's already in the language, but we also include in there in the proposed language that the exercise of that's being exercised by the commission has to be based on pecuniary factors as well. And that if we use a proxy advisor, then the proxy advisor has to have a practice of and commit in writing to follow that guideline. And that if we're going to allocate capital to an external investment manager to manage a public investment a public equity investment strategy for us, they have to adhere to those guidelines as well. Or if they're not willing to do so, that we can only allocate the capital if that's the only economically practicable option that we have, or if it's necessary to avoid concentration risk. So, that's a kind of a summary of the additions when it comes to proxy voting. Again, just trying to give, and there's also a requirement in there that the commission one meeting per year would review a report that basically summarized the proxies, the proxy votes that were either done by the commission or on our behalf.
One question.
Yes, sir.
So they have to basically follow what you're saying, I think.
Yes, sir.
They have to follow our guidelines or our rules.
Yes, sir.
How are we gonna monitor it?
And that's the report that that we'll get from we'll have it'll be incumbent upon staff to produce a report that has basically has a summary of all of our proxy votes. So we'll be monitoring.
So you look at it once a year, I guess?
Yes, sir.
Okay.
Yes, sir. And we'll bring it to the commission.
It won't be a continuous.
Yes, sir. It'll be a continuous thing, and it'll be basically once a year, it'll be an agenda item for the commission to receive the report and to ask any questions.
Perfect.
And ultimately what we're trying to do is, if this is, we're just really trying to, like, for the proxy voting, just provide a greater degree of transparency and clarity. But as a whole package, when we're thinking about the potential reforms that the General Assembly may be looking at, we're trying to go ahead and incorporate those for what we think is probably the most likely outcome. So that way we can say that we've already addressed this in our foundational documents, which is the SIOP. Any other questions about that part?
And you don't have to worry about us reviewing 2,000 proxies at each meeting.
Yeah, yes. So the also, in there you will see that we have some conforming changes in the document, which is done every year, that are based on our new capital market expectations. For example, table 1 and table 2, which shows our the Monte Carlo scenarios that we do for where we try to give an idea of when we feel that we'll get to a fully funded status based on the expected return and volatility of the portfolio, as well as our expectations in regards to the impact on contribution rates. So there's various changes throughout the beginning of the document that you'll see that are really related to the new capital market expectations. And just of note, previously when Makita was our investment consultant, a lot of that was based on 20-year forecasts. This is based on what you'll see now with with Verus, is based on a 10-year forecast. But in speaking with Verus, the 10-year forecast or the 10-year numbers really line up pretty congruently with a longer-term 30-year forecast as well. So, but that is somewhat of a change, so I want to make sure that we noted that. On page 21 of the black line document, you'll also see that we're recommending that we carry over the fiscal year 2022 strategic initiatives, because we believe that there's still work to be done on those, and those still have relevance when it comes to what we'll be concentrating on over the course of this fiscal year. Certainly, if the commission has other initiatives that it would like for us to focus on as well, which are more shorter term goals, then we can certainly incorporate those as well. You'll see also on page 25 that there's a recommendation to change the portable alpha benchmark from the HFRI fund of funds, conservative fund of funds index, to cash, to the cash rate, because our thought is the cash rate is basically the cost of the futures contract when we're doing that in the overlay. And so to the extent that our hedge funds deliver us a return above that, then they're adding value. So that's where we're making money. Because interestingly, what we saw in over the past, couple of quarters over the past year is that HFRI index was actually negative. So, when you incorporate that into the implementation benchmark, then it actually, even though our hedge funds were positive, the index was actually negative, and it makes that decision, it's not congruent with why we have them in the decision that we have in order to have hedge funds in the portfolio, because if they clear the cash rate, they're adding value to the plan. So that's a recommendation from us to change that benchmark, but certainly be happy to go more in depth with anyone on that offline if you would like. Just another small change, there's a language in the SIOP now that creates the expectation that we're going to be looking at the compliance with the ranges of the asset allocation on a weekly basis. We're just changing that expectation to monthly because that lines up better with, the information that we have. So, and then there's just several technical formatting changes and updates, but those are not necessarily substantive, just, changing dates and doing things like that. So, certainly happy to answer any questions that anyone has about any of those.
If we're changing the portable alpha benchmark to cash, is that, do you mean the money market rate and or do you is that the net cash, in other words, constant dollar cash or just cash?
It's basically
Reynolds, this is Jeff. The rate is the SOFR rate, so think of that as LIBOR.
Yeah.
It's the new LIBOR rate, so it should be very comparable to a money market rate over time.
Okay.
Yeah.
Any more questions for the CEO for his report?
And like I said, certainly happy to, if anyone has any follow-up questions or any other, would like to meet about any other potential proposed changes, please, get with me in the interim in between now and the April 20th meeting, and certainly be willing to go through those and talk through any of the proposed changes or any other recommended changes as well.
Anything else for Mike? All right, well, next up, I'm gonna call on Jeff Berg, and he's gonna give us a quarterly investment performance update.
All right, there we are. Okay. Thank you, Mr. Chairman. What I'm going to do today, in light of the fact that we are at calendar year end, is give a very quick update on the fiscal year, but also check in a little on our longer term performance, and by which I mean focusing on the 3-year performance. So for the most recent quarter, you can see here we earned more than 4%, which brings us back slightly positive for the fiscal year halfway through. We did lag our benchmark during the quarter by 18 basis points, but are still outperforming by just over 1% for the fiscal year. We are also, I think it's noteworthy and a testament to the quality of our team, we are outperforming the benchmark over all longer periods of time as well. One thing I think is worth spending a quick moment on, the 3-year return stream. You see here, we've earned 6% over a 3-year period that has had 2 bear markets. In 2020, you may recall, we got off to in this 3-year period, we got off to a terrible start because COVID just landed. Global equities declined by 34%. And then this past year, peak to trough, they declined roughly 26% due to the rising inflation concerns as well as the war in Eastern Europe. So I'm proud of our return against that backdrop, earning 6%. Excess return being pretty considerable over that time period, north of 2% as well. On the excess return, I believe, I did not fact check this, but I believe that we began this 3-year time period with the worst single quarter relative to our benchmark. And we've very clearly made the full recovery and outperforming by 238 basis points annually over the last 3 years. So just goes to show you sometimes we need to remember that things don't work all the time, but the important thing is that they work over time. So
And what's driving that return, that good, like 6%?
the relative return,
Yeah.
we've had, so it's a whole host of factors. We have outperformed in every single asset class
Okay.
over those 3 years.
Small class.
But also, we've had our active weights have paid off, meaning we've been early in that time period, we were overweight equities. We've scaled that back. We've had very strong returns during a period where our private markets have been overweight. They've been very strong relative to public markets as well. One final thing I do like to check in, and in light of the fact we're going to have our actuaries in the meeting in a few moments, the annual run rate of net benefit payments is now below $500 million. 1 year ago, this number was $572 million. So we're still seeing a continuing benefit to our liquidity management from the higher contribution rates as a result of the 2017 legislation. So let's check in on the portfolio framework quickly. What jumps off the page to me continues to be the rocky history recently for the 70-30 portfolio. It had a truly terrible 2022. And by employing a diversified approach, you can see that our policy benchmark has considerably outperformed by more than 5%. And thanks to the team that we have, our actual returns versus the policy have been considerably better as well. I would love to see the 70-30 portfolio make a really big recovery, because that does continue to be a big part of our portfolio. So I don't want this to be taken as a alternatives versus traditional assets. We know that these things don't always work well at the same time or poorly at the same time, and last year is a pretty meaningful example of that.
You've been muted. To unmute yourself, press *6.
That is not where I thought this meeting was going.
Somebody telling you something?
I'll stop. I'll leave it here. Any
No
questions?
longer muted. You've been muted. To unmute yourself, press
You were already told once.
Yeah, this is, I guess I need to learn my lesson here.
Andrew promises he's not doing it.
I thought it was you, Mike. So,
You've been muted.
Sure, that's gotta be him.
That's gotta be Andrew.
6.
all right, well, we're gonna hang up on our meeting, so. All right, so during the most recent quarter, only half of our asset classes outperformed their benchmarks, hence the slight underperformance. When we look over the full year, 5 of the 6 asset classes have, or I'm sorry, over the 6 months, the fiscal year to date so far, 5 of the 6 asset classes are outperforming. And on a trailing 3-year basis, I already alluded to, every asset class has outperformed its benchmark. So I'm going to skip a few pages as a courtesy to everyone, especially the phone system. And I want to stop on the allocation effects. So we're looking at the impact of allocation decisions over the past 6 months, and this is overweight and underweight in asset class. We have been overweight private assets and underweight bonds for 18 to 24 months, and that has been very, very good for us. But here over the first half of the year, it hasn't been good for us. And these numbers are small relative to the benefit that we've seen over the last several years. But I think it's important in this most recent quarter, the big rally in public equities means that these impacts, which had been positive and we would expect to be positive over longer periods of time, were negative in the quarter, and that makes them the magnitude makes them negative for the fiscal year to date. Just so happens the only asset class benchmark that outperformed our policy is the public equity portfolio, and we have been underweight because we have been using that as a way of reducing the risk relating to our significant overweight to private equity. But you can see that those two factors here are having the biggest impact and account for essentially all of the negative allocation effect. As far as our implementation, this is how do we construct an asset class to look differently than its benchmark. You can see most of the effects are very small. Even portable alpha hasn't had a significant performance impact so far in the fiscal year. The only impact that I would characterize as meaningful has been the floating rate exposure inside of our bonds portfolio. But we'll talk later today. That floating rate exposure is coming down now that rates have risen. Manager selection impacts continue to be very strong across the board, and the first 6 months of the fiscal year is no exception to that. Each of our alternative asset classes is outperforming its benchmark, in most cases significantly. So this trend continues to be positive. Let me jump ahead to our compliance slide because I want to make sure I'm flagging this, continuing to flag this. And by this, I mean our overweight to private equity. We are at 15.4%. Our target is 9%, so we're overweight by 6.4%. This overweight did tick lower by about 0.3% during the quarter, largely a function of public markets raising the plan value. The total private markets continues to exceed the 30% notification limit, so I will continue to flag that. The overall excess exposure over that 30 to our private markets portfolio came down 1.5% during the quarter for the same exact reason. From a volatility perspective, each of the figures you see in the top row is about 0.4% higher than it was last quarter. Our model is still suggesting that the policy benchmark is slightly under-risked versus the reference portfolio, but our actual implementation reflects more risk than the policy portfolio, and that is a function of, think of that as a function of three factors. One is we are overweight private equity by what we just saw as a very significant amount. Two, we are underweight bonds, and three, we have an overweight to real assets. So that is what is driving and the existence of the portable alpha program. So that's what articulates the difference between these two numbers. Finally, during the quarter, our realized risk numbers rose as well. The volatility of the reference and policy portfolios rose by more than 0.5%, I think it's 0.6, while the implementation and actual portfolios rose a little less by about 0.4. So let me stop here and see if there are questions on any of what I've just hustled through so as to not offend our phone system.
Questions for Mr. Berg? Hearing none, thank you, Jeff.
All right, thank you.
Next on the agenda, we will now hear from our investment consultants, the folks from Verus, and recognize Mr. Mark Brubaker, and Mike is over there waiting in the wings.
Eagerly.
So the floor is yours, Mr.
I'm going to
Brubaker.
put him on later on today, but thank you, Mr. Chair. And this will be the first time that Verus has had a chance to walk through our annual capital market assumptions with the group. I plan on going through it at a fairly high level, but if there's anything that you want me to drill down on in a more meaningful way, just please let me know and stop me along the way. As I mentioned, these are our forward-looking capital market assumptions. Mike had mentioned earlier, They're designed to be 10-year forward-looking assumptions. They're our best estimate of what we can expect from the markets over the next 10 years. And they are very similar to, we also publish 30-year assumptions. We think the 10-year assumptions are much more appropriate when it comes to determining asset allocation policy and making those kind of decisions. But 30-year assumptions are probably more in line with what your actuary would be using on an ongoing basis. And you know, as Mike said, we looked at it, and the difference between our 30-year and our 10-year is nominal and not meaningful. We update these assumptions annually, and then we provide further updates quarterly. You can imagine, like, most of the time the quarterly updates aren't meaningful, but last year they really were as interest rates rose. Because I'll talk about this in a minute. We use a building block approach, and as interest rates rise, fixed income forward-looking return expectations rise along with that, and that influences all of the other asset classes along the way. I'll talk a little bit more about that in just a minute. I think across the board, our assumptions were largely higher. There are a few exceptions, and I'll talk about those. And then the bottom line is, based on our expectations and your asset allocation policy, we have an expectation of 7.3% for your portfolio based on those assumptions. And that represents about a 1.1% increase from what it would have been with our 2022 assumptions. So that's
7.3% over what period?
That's looking out 10 years, annualized over 10 years.
Okay.
So 7.3% per year over that period.
We take it.
We'll take it. I mean, that's one of the, you know, we endured a lot of pain in 2022, one of the worst markets ever. And one of the benefits is that kind of elevates forward-looking return expectations for all asset classes.
So that's a good return.
So that, I mean, that's good. You're obviously your actuarial assumed rate of return is 7%. So I think that gives you a comfortable cushion over that before any of the work that Jeff and his team do to add value on top of the policy.
How do we stand with other states?
Pardon?
How do we compare with other states?
In terms of expectations?
Yeah.
I think you're right there, but in line. So 7% is the median. If you look across all of your peers, the 50 largest public pension funds, the median has come down. Over the past 12, 13 years, it had been as high as 8. And now it's at 7. So you're right there in terms of expectations.
Mark, are you talking the expected return driven by asset allocation or the
Actuarial, the required rate of return. And then I was going to pivot, and when we look at the 7.3, it's probably a little lower than your peers for some of the reasons that Jeff mentioned before, where you have a higher fixed income allocation overall. So that would drive your return expectation a little bit lower. Just to get into some of the methodology, I'm not going to read through this line by line, I promise, but I thought just to give you an idea of how we look at things. I mentioned we use a building block approach. You know, if you think about it, you start with inflation, which influences cash, and then you look at your fixed income yields, and then on top of that, equity returns. And so cash yields at the end of 2021 were 0, basically 0 to 25 basis points. They ended 2022 at about 3%. So that's a big bump right there. The 10-year Treasury ended 2021 at 1.8. It doubled to 3.6 at the end of 2022. And then everything else flows from that. So if we look at equity, the way that we derive equity is we look at the current yield, the dividend yield provided by equity securities. We add the historic real earnings growth on top of that.
How do you get that?
That's looking backward. That's for the entire history that we have in terms of earnings growth. So taking the historical average there, adding our inflation expectation on top of those earnings to get a nominal return expectation, and then we have this last piece, which I would call kind of a toggle in the equation, which is the expected PE change. And I'm going to talk a little bit more about that because it actually influenced U.S. equity and non-U.S. equity in opposite directions. U.S. equity right now is, when you look at it relative to a Shiller PE, which is it's a 25 normalized price to earnings multiple. It's a valuation measure of the market. It right now is near near its highs if you look at it relative to historical levels. Whereas if you look at international equity, it's the price to earnings multiples there are in the lowest decile they've been in history. So we see a valuation disparity across the markets, and that influences the return expectations that you're going to see in a few pages here. The other one I would point to, well, private equity, we use a domestic equity forecast with a beta adjustment of 1.85. And then on top of that, there's other adjustments we make. And the one big adjustment that you'll see is the cost of leverage. Private equity utilizes leverage in a meaningful way. And the fact that leverage has become more expensive, that dampens our forward-looking return expectations there for private equity. Bonds, nominal bonds, we use the current yield, yield to maturity. And if you look historically, that's been a really strong predictor of future returns. So if you look out at 10 years, there's a really high correlation between the current yield to maturity and the next 10-year return you get there. And then for real bonds, inflation-linked bonds.
You are not allowed to unmute. To raise your hand, press star 5.
we use real yields plus an inflation forecast. I'm not going to go through all of these, but I thought that was worth noting. Also, the other asset classes, there's two asset classes you're going to see where we have lower expectations this year than we had last year. All the other ones increase meaningfully. The two are private equity for the reasons we mentioned, which is the cost of leverage, and the same as with core real estate. The cost of leverage has driven the return expectation there lower. Yes, sir.
What is the inflation forecast?
The inflation forecast is 2.5% over the next 10 years, annualized. So that's built into that is a higher inflation, obviously in the forward years, the current levels, but with the expectation that somewhere between now and year 10, we get down to the Fed gets down to its target 2% level, and that average would be 2.5%.
Did y'all make an assumption about Treasury rates and where they're going to be over, or are we going to get? Hopefully we won't get back to zero or anything,
right,
but where they're going to be over the next 10 years?
We assume more. I think the 10-year we don't expect to move much from where it is today. But as you know, the yield curve currently is inverted. I think 6-month yields are at 5.2%. The 30-year is below 4%. So this is the most inverted the yield curve has been since 1981. So we think that the yield curve will normalize. Short rates are likely to come down over time, and we'll have an upward sloping yield curve. But we don't have any projection as to when that's going to take place. So. And then our inflation assumption, by the way, is based on a number of things, but the two primary things, when you look at the University of Michigan survey, which is, a subjective collection of experts' estimations for inflation, but then we also look at the market's expectation for inflation. If you look at a 10-year inflation-linked bond or TIP security versus a 10-year nominal bond, the differential in those yields is the market's expectation for inflation over the 10-year period.
Okay, thank you.
So Mark, not to belabor this, but
yeah,
what events or what factors do you guys feel like will force the inflation rate back down to that 2.5 level from where we are? I mean, to me, that looks like, am I hearing that there's storm clouds on the horizon for our economy? Is that what we think's going on?
Well, I think, and this isn't necessarily a Verus forecast, but I think when you look at the inverted yield curve has always been a pretty strong signal that the market's expecting a recession on the horizon. And unfortunately, I think that's probably the main thing that's going to bring inflation down in the near future, if it does. The other thing that will bring it down are some of the things that we've been grappling with after the reopening after COVID. Getting, supply chains are close to being back to normal, but they're not fully back to normal yet. So that'll have a more modest impact on inflation. But primarily, I think they need to slow economic activity in order to bring that inflation rate down.
Pain.
Pain.
Okay.
No pain, no gain.
All right.
So you can see here, just again, I'm not going to read through number by number, but as I mentioned before, if you look at our assumptions for U.S. equities, a couple things that strike that are interesting. For the S&P 500, we expect 6.5% per year over the next 10 years. But then if you look at the next line, the small cap stocks, Russell 2000, we have a lower expected return for small cap stocks. That doesn't happen often, and it's really a function of, and I can show you these numbers if any is interested, but small cap valuations are at historically high levels, and so we have a bigger adjustment factor for a PE multiple reversion there, which causes the return to lower. And then I mentioned international. If you look at EFA stocks, this is probably one of the widest margins I've seen in our expectations between international stocks and U.S. stocks, with a 9.1% expected return there, and then 8.5% for emerging markets. Private equity still commands a premium over those, but the premium is not as high as it had been historically. And again, because of the leverage they use and the cost of leverage. And so without going through number by number here, but
Mark,
I'd be
I'm sorry,
happy
can you
to.
go back?
Oh, yeah, sure.
The category is private equity direct. Can you
Yes.
explain what that direct means?
So private equity direct, we have a number of different private equity assumptions that we use for clients. This one best reflects what you're doing, which is direct partnership investments with some co-invest with. We
as opposed to through fund of funds?
that we have a fund-to-fund assumption and some kind of blended assumption. So there's three. This is most appropriate for anybody that's doing what you're doing.
Okay.
And the highest of those three, for that matter.
Even better.
Yep.
And why is international so much higher than US?
Let me go to, let's see, I don't have the numbers on this page, but let me just show you in the appendix here. If you look at these equity return forecasts, and let's just focus on the far left-hand side of this slide, which is U.S. Large cap stocks, and then two over, which is international developed. And you can really see the return differential there and what's driving it. So in the case of U.S. large cap stocks, the dividend yield for U.S. stocks is less than half of the dividend yield for international developed. That's the green bar. So that's one of the big drivers. And then the other big driver is if you look at the valuation change, you can see for international developed, there's a big positive orange bar, big positive valuation change because it's trading right now below its historical averages. Whereas in U.S. stocks, you can see a modest negative effect from the valuation change. So I would say those are the two primary drivers of what's leading to that return expectation gap.
In 14 years, by the way, I can't recall having a international developed expected to out-earn emerging. Which is an interesting development here as well.
That's true. And again, you can see the components there, and it's really expected looking at the historical earnings growth, it's muted for emerging markets. So in the interest of time, I mentioned we have two asset classes, two that would impact your portfolio that actually are lower than last year. This shows all of the differential between this year and last year. But you can see private equity is about 30 basis points lower than what it was in 2022. And core real estate is about 70 basis points lower than 2022. And again, that is because of the use of leverage and the increased cost of that in the portfolio. And then, so lastly, and this is really, I think, what everybody wanted to see, what we show here is our long-term expectations for the RSIC portfolio. And if you look at I generally think the middle is what I would use for your overall asset allocation. There we incorporate expectations for portable alpha. On the far left, we do not. But you can see that our 2023 assumption for excluding portable alpha is 7.35, with portable alpha 7.43. And then your reference portfolio, which is 70% global stocks, 30% investment grade fixed income, that actually got quite a bump from where it was last year. It's up that has an expected return of 6.7 versus 4.9. So I think the theme that you're seeing, and we're seeing with our clients across the board, is kind of a overall simplification of the portfolio. That, you know, it's easier to meet your actuarial return hurdle in the current return environment than it had been. So at the margin, I think people are abandoning more complicated structures. I shouldn't say abandoning, but you know, at the margin, moving away from more complicated structures and returning to simplicity to some degree.
I observed that
Yes,
the
miss.
private equity suggests a 9% allocation, and I know that's been
Right.
and you might be planning to speak about that and how we get from where we are and what factors are involved.
Yes.
If so, I'll wait for your remarks.
We are definitely going to,
Okay.
we're going to cover that later on today, but you're right. This is based on your policy allocation. So this would assume that you're, you know, in reality, if we modeled.
Oh, I'm sorry,
Yeah,
I was misinterpreting. Hey, this isn't your recommendation. This
No.
is just saying, based on how we have it now, that's what you.
Right, based on your
Okay.
current policy, this is what you could expect to earn. If you factored in your over allocation to private equity
Right.
and private debt and real estate,
Then-
it would actually be meaningfully higher than
Right.
what that is.
Okay.
And so I think that's the other interesting thing, you know, Jeff talked about risk a little bit. If you look at the bottom of the page, we show the standard deviation for each of those portfolios. But if you look at the bottom, I like to look at the bottom 25th percentile, the bottom 5th percentile. So what happens in a 1 out of 20 bad year? What could you expect from the portfolio? And you can see, again, if you look in the middle group, that number is about negative 11.3% in a bad year. So that compares favorably even to the reference portfolio, which would have a negative 11.7% return in the 1 out of 20 bad year scenario. And so I think, you know, overall the news is good. The forward-looking returns are higher than they have been. I'm happy to answer any questions on that. I know we're going to talk about private equity later, and so I'll stop there.
And I don't expect you to have this answer because I probably involved a lot of calculations, but I'd love to see, you know, those forecast numbers for our actual portfolio.
Yeah. Oh, we can do that.
Yeah.
Yeah.
Oh,
We'll do that. In fact, I think we did that, was it a couple meetings ago when we looked at the risk and but we can do that and show it's going to have a variation not only on return, higher return, but also a higher expected risk.
yeah.
As you know, so.
How
Right,
much-
and since we might be, I'll just use the term, but I don't mean it derogatory, stuck kind of because of market, the nature of the market today, stuck in higher private equity.
Right.
You know, I expected it to have higher risk.
Right.
That's one reason love to see it.
I'd be interested in that too, Mark.
Okay.
How much doing would that take for you to get that out to the commissioners?
It would take us less than a week. We can get it to you next week.
Would you be able to just send it directly to us with, you know?
Mark, one thing that stands out is the difference between the two mixes. Portable alpha being the only distinction.
Yeah.
It's only having an 8 basis point impact. Can you talk a little bit about?
Yeah, so that's two things. So, and you look at 2022 and it had a much more meaningful impact, right? It had 30 basis point impact versus 8. And you mentioned it earlier, the cost of transferring the alpha is now higher, significantly higher. And so that dampens the expected benefit from the portable alpha program. Now, keeping in mind that this assumes index-like returns for not that there's a hedge fund index, but market-like returns for the hedge funds versus SOFR or LIBOR or whatever cash yield you use. So in our mind, I think it's still worth doing. And it's certainly not something, even if this number was flat, let's say, I would expect that to be a temporary condition, and that you wouldn't want to unwind a program like that just in response to, you know, one forecast.
Well, and I was going to ask if, adding on to the chairman's question about should we read into it,
Yeah.
there's a recession, you know, potentially in the not too distant future, do you see cash rate coming down in that environment, and therefore you restore some of the
I do.
attractiveness?
Yeah, and I mean, like I said.
Get Ian here, we'll find out what he says. So.
Yeah, oh, Ian does. No, but, you know, right now, the 1 month is at 5%. And that, I mean, it's not sustainable to have that at 5% while the 30 years at 3.9%. So we do think short yields are going to come down. Longer yields might rise, but the yield curve, it's not going to remain inverted forever.
Let's hope.
Let's hope. Yeah, that would be bad.
Okay, thank you.
Thanks. Any other questions on the return assumptions?
Yeah, one more, please. And this is kind of, because treasuries are paying more now than they have in recent history, and we're underweight bonds, do you, and I know this is an implementation decision for Jeff, but what as a consultant, what do you see that we would probably likely want to start increasing that allocation to bonds and getting some higher rates and lock them in?
The answer to that is yes, and
you're going to be very happy in a few hours.
Oh, am I?
So I don't want to steal Jeff's thunder.
I can't, a few hours.
That's the deep dive today.
No, okay,
so
good, thank you.
Can we table it for that?
Yes, sir.
Yeah,
Yes, sir.
Thank you. But great question to ask, by the way.
Yeah.
Well, I'm doing it personally, so, you know, so.
Any other questions for our consultants from Verus? All right, hearing none, moving along. Next item up is an actuarial update from GRS. Okay, I'm told we need to take a
hard reboot.
10-minute break. Let's take a 10-minute break, folks. My phone says 10:30, so let's round it back. Everybody get rounded back up at 10:40.
Welcome to the party. Well.
Are ready for the presentation they're going to give us today. They're presenting virtually. IT folks, do we have them teed up and ready to go? All right. Joe Newton, are you online, Joe?
I am.
You are. Well, I'm gonna turn it over. I'm gonna turn it over to you. Please fire away.
Very good. I'm going to turn it over to Danny. I let him get it started.
All right. This is
morning, everybody.
Mr. Danny White. Welcome.
Yes, sir. Good morning. Good morning, members of the Investment Commission. I'm Danny White, and with me is Joe Newton, actuaries with Gabriel Smith, and work with PIBA on the valuations. We're going to present the latest valuation and give some projection information along with it. Valuations are prepared every July 1st, so the next one will be performed July 1, 2023. So even though this is almost 9 months old, it is the latest information out there. If we go to the next slide, we go through the agenda of just some high-level information. You all are very attuned on the investment side, so we'll give you some high-level information on demographics. 2022 valuation results, we'll give you some forward-looking information on SCRS and 4s, some stochastic and other risk measures. And then I understand we have a few new board members on the RSIC, so I want to go over the the funding reform, which was significant, that was enacted in 2017, which plays into effect today. There was much work done by PEBA and the RSIC to get the legislators to put this in statute, and it has operated quite well in our opinion. So we'll go to the next page. Just kind of contributing membership in SCRS. So you think of your workforce out there, how's it comprised? We got the red line at the bottom, your Class 2 members. These are members hired prior to July 1, 2012. Class 3 members have slightly small variation in benefits come in the blue, and you can see how that demographics changed over time. The next one above it is you see the state ORP, that's the defined contribution plan. And that's an optional form that people can earn benefits in, or state employees and public educators can elect to earn their benefits. And then finally you get the top group in yellow. It's working retirees. Think of these people as, they're retired, they're receiving a benefit, but also they return to work with a participating employer in SCRS. And, because of reform changes again in 2012, you see how these things have shifted or changed over time. And then overall in the membership growth, you can continue to see an aggregate, increased membership in SCRS. If we look at the next slide, look at the retirees, people collecting benefits, how that has evolved over time. So again, you have the bottom, the red portion. These are regular retirees, just normal retirements. People have started their benefit once they become eligible. Once we build on top of that, you have retirees or disabled retirements. And then on top of that, you have beneficiaries. So if you look at it today, or 2022, you got an even split of about 12,000 each, beneficiaries, disabled retirees, and about 127,000 regular retirements. And that number will probably continue to climb and along that same trajectory going forward. So we looked at counting the members. We go to the next slide. Look at contributions. The benefits in, contributions in, benefit payments out. So we have the contributions on the green line and how that's changed over time. And you can start to see from 2017 to 2018, I think you start to see a more material change or increase in contributions. A lot of that's happened to be the catalyst behind that, the reform and that was enacted in 2017. And then on the benefit payments, you see a spike there in 2018. That was the Terry program. It was an account balance type program. Retirees could put their money in if they chose to participate, and that actually closed out at June 30, 2018. So that's the reason for the spike and the dip. This was all very much anticipated, in developing the cash flows and that. So, and there is a reason behind it. It's just not an anomaly. Go to the next slide, and one more. Kind of think of what was the experience since the prior evaluation. You had in FY 2022 it was a negative 0.9% return on market on investments. Just note for completeness, for June 30 plans, that was on the more favorable end of the scale compared to other statewide retirement systems. So kudos to the RSIC for that. In terms of the dollar amount of the earnings, what it means for us as actuaries is there was $3.2 billion less in earnings than expected. So the bogey there is the benchmark of 7% return. It's not the actual return, or zero. So we expect 7. So how are we compared against that? And as we look through it, and as Joe will explain in our show and some other projections going forward, if you look at over a 2-year period, because FY 2021 was just phenomenal, you actually had $5.9 billion more than expected. So if you look at the 2 years combined, that's where we're getting to on the next bullet point, is you still turn out more favorable when you look at it on a 2-year basis. On the liability side, there were some salary increases larger than assumed, and we kind of note that or what it was. You know, for years we've had salary gains, and at some point, you know, there's going to be a catch up, and you know, government budgets are doing well, and you get the pressures of you know, maintaining the workforce, and so this is going to catch up. This is, you know, having salary increases is actually can be a good thing overall, or at least a neutral item. While there is a liability increase, think of it, you're collecting contributions on payroll. So when your total payroll goes up 5%, even if the contribution rate doesn't change, although it is going up, you're getting more dollars. You're getting 5% more dollars in contributions that come into the plan. So it is a plus in that regard. If we go to the next slide, we got a summary of the VAL results we got the first two columns, SCRS, then the other two is PORS. I gave you a side-by-side comparison, 2021, 2022. There's no changes in plan provisions or assumptions between the two. So it really is monitoring liability and asset experience. For valuation purposes, we use a calculated asset value that recognizes gains and losses over a 5-year period. So we'll show you the effect of that in a subsequent slide. But what that does is that takes care of the inherent short-term volatility that you might see on the funded ratio and how that affects you know, the funding period, and just for business making decisions of you know, in terms of a contribution or funding strategy. Member contribution rates remain unchanged. The employer contribution rate is scheduled to increase again for FY 2024. There's a one-year lag in here, and this goes from 17.56 to 18.56, and it's projected to cap out or remain steady. And again, this goes back to Act 17, the enactment of fund reform in 17, and we'll show you, we have information on that later. And then you think about calculated funding period or effective funding period, and we're down to 17 years, assuming that 18.56 remains in effect all future years. And then you see on the bottom what that does in member and employer contributions, and you can see this is where I highlighted earlier about the member contribution rate stayed the same, but the dollars go up because you have more payroll. Same thing for PORS, you know, similar story, just different magnitude of the numbers. If we go to, actually, we're going to skip next slide. Here we go. We'll show historical and projected liabilities. So the solid portion of the graph back from 2012 to 2022 is a 10-year history of what was the liability, how has it changed over time, as well as the assets. You got the green value of the assets, you got the actuarial value, the calculated value for funding purposes, and you can see that gap or that difference between the two is your unfunded liability. So that's historical. Once we start getting forward-looking, this is based on the funding policy. So we have assumptions being met, namely the 7% return expectation. How does the liabilities progress over time? And then you see on the assets, you know, we're not assuming any gains or losses. So those, you know, the calculated and the actuarial value, the calculated and the market value sort of converge. But you can see where we're taking out some of the inherent short-term volatility on the green or the market value, and you know, just it creates less distortion or in the you know, for thinking of it in terms of cash contributions or funding policy. Next slide, please. Joe?
Yeah, I wanted to step in and talk about the unfunded liability. Because one of the main numbers you see Danny talked about earlier was that funding period, which actually in statute it talks about there's a certain amount of time that we can allow for this unfunded liability to be paid off, and if we get outside of that boundary, that's when contribution changes or other things need to be considered. And so we go through these calculations trying to estimate when we think the unfunded liability would be paid off, just like the previous slide Jane showed, that convergence. Well, it's one of those things where you can have all this communication and all this fancy numbers telling you you're going to pay it off at some point. But if you can't ever actually see the unfunded liability getting smaller, it becomes harder and harder to argue that that funding period is going to be met. And so here's one of the things we're watching is this unfunded liability to actually get smaller and start to decline. Because if you look at the last 20 years, which is what's on slide 11 here, this blue line, it hasn't hardly gone down at all. In 2011, when it went down, that was a benefit change. So, every year it's grown. And so now that we're at the top of the contribution schedule, we do now expect this unfunded liability to begin getting smaller. This year, it would have gotten smaller if not for that salary increase. In fact, it took the investment return just fine. It was the salary increase that was across the board that kept us from slightly declining. And you can see the little red dot there. We are expecting next year's report to be a little smaller and to begin to get smaller and to be smaller every year thereafter as the funding policy continues to kick in, and that gets you there in 17 years. But anyway, this is kind of what I call tangible evidence. It's not based on a bunch of assumptions and things. I want to see the actual line getting better, and I think we're really, really close here.
Joe, if we go to the next slide, if we project this out going forward, you take that blue line that you saw on the prior page, and if we extended that forward, how would that look? Although in terms of bar charts, so the bar charts represents a dollar amount of the unfunded liability, and what we're doing is we're providing a comparison of last year's story to this year's story, and so we say, all right, it's still going to be trending down, but not at the same pace because of the last year's investment experience, but it's still beginning to trend down. And that's a big part of that is the contribution effort that the contributions going into the plan are not just covering the interest on the unfunded, but they're starting to actually pay down the unfunded liability as well. And then on the lines, the two lines, represents the funded ratio and how that is projected. That's projected to increase the funded ratio as percent of assets over liability, how that is going to progress over time. All right, next slide. So summary of the 2007 funding reform, and I want to spend some time on this. This was particular importance. This is significant. There was a lot of work. I remember a lot of work that was put into this, a lot of scenario testing, stochastic analysis performed by RSIC and ourselves, really much of a joint effort to present in presentations multiple times to the legislators on, we were in a state where the employer contribution rate was 11.56. At the time, it was realized and understood this is going to need to come up, and this is going to need to come up, fairly materially. And so this could either be done either by board control or do we need to put something in statute to really map out and be transparent on the plan for all stakeholders understood what's going to happen. And so if the end result is they put in the statute where the 11.56 that was in effect for FY17 was going to go to 13.56 beginning of FY19. And then there were step-ups that were going to occur each year all the way through where we're at now. The effective rate is 17.56. And next year, starting July 1, 2023, it's going to be 18.56 for SCRS. And it stays there unless there's a couple things that happened. One of them is, Joe mentioned about a maximum funding period. So you see it down there. When they put that statute in, there also a maximum funding period, which was 30 years. And that steps down each year until it reaches 20 in the year 2027. And so right now we're at 25 years at 2022, and that's going to step down. So think of this as your backstop. If you got a baseball stadium or whatever, you got a backstop back behind you to make sure that these contribution rates in statute, while they're projected to remain sufficient in getting that funding period and paying down the unfunded, there's another step in here that just to make sure if something goes out of whack, for whatever reason, that you have a maximum funding period. And if that maximum funding period, if the current contribution rates don't satisfy that maximum funding period, then the contribution rates have to go up to be sufficient to do that. So that was I think that was important. The other item, in terms of the contribution rate, it in statute it remains in effect until the funded ratio of the system, I believe, is 85%. And so even if it goes up, and that's the case if the rate goes up, it remains in effect until the funded ratio of the plan is 85%, and then there's steps in there about how things can start to back off or reduce. The other in the funding reform is they looked at changes in the assumed rate of return that was 7.5 at the time and went to 7.25, and then at the recommendation of the RSIC and PIBA, it went to 7% in 2021 and is in effect there now. Are there any questions about the funding reform in 2017?
Danny,
Okay.
Danny, this is Jeff.
Yes,
Sorry.
sir.
Can I ask a question? So let's play it forward. We get to 85%. Can all of the higher contribution rates fall away, or is there a step back down structure to that?
There's a step down process.
Okay.
But it doesn't, but the statute doesn't require that the contributions, they don't automatically be reduced.
Right.
So the PIBA board could reduce them once it gets to 85% funded, but we, of course, that's 16, 17 years out, but the General Assembly hasn't expressed any appetite to reduce those contribution rates until the system is fully funded. So the statute only allows a reduction once it reaches 85%.
Excellent. One other question. So we've tightened up a whole bunch of assumptions. We have more money coming in to the system, and all this puts us on a great path. But we've been lowering the assumed rate, which is another assumption that is conservative, but it's kind of masking the progress to some extent. Can you talk about, and Peggy, maybe this is a question for you, if we made all these changes but just hadn't changed the discount rate, would it be easier to see the progress being made? And if so, kind of what's the delta?
And Danny, I don't know if you want to answer that, because I don't know if we have done those projections. They were certainly done in 2017 when the legislation was enacted. We did, the actuaries did a number of scenarios showing, what happens if you kept the rate of return at 7.5? What happens if you reduced it all the way to like 6.5? And what the contribution requirements would be. But I don't know that we have anything. I mean, Danny and Joe could probably prepare that.
To be clear, I'm not suggesting we would have done anything different on the investment side, just the value of the different discount rate on the liability side is.
You're right. It has masked some of that evidence I was talking about, that you could actually just see that it would be improving. I know in last valuation, when we went from 7.25 to 7, that the unfunded liability would have gotten smaller if not for that change in that 1 year. So, so I do think that you're right that it would be easier to see. But going forward, at least right now, we're not anticipating any kind of material assumption changes in this program for a long time, unless things just totally change on us in ways that are hard to fathom right now. So I think we're past that, but I think it's a very valid point that some of the progress that has been made has been absorbed by assumption changes over these last, say, 5 years. But we're not anticipating that anymore going forward.
Yeah, I've got a couple other comments. Let me go to the next slide as I discuss that is, if we go to slide 14, please. When this, like I said, there were a lot of discussions that occurred about the schedule. What would the new scheduled employer contribution rate look like? And there was a goal of hey, we want to put a plan in and you want to think of there were two things that came to mind. One of them is, you know, in 17, 18, you know, you had a lot of great experience since 2008, 2009, and it was like, all right, sometime we're due for, you know, some type of correction or some type of event that, you know, we're trying to reflect. And so I think a lot of it was maybe a negative 5% return without a rebound or so. The other thing that when this schedule was put in, there was also discussion about the assumed rate of return needing to be reduced or needing to be adjusted, because it was 7.5% at the time. And so they wanted the projected that increase in employer contribution rates to kind of encompass or be sufficient to take care of both those items with a high degree of probability or likelihood. And so this kind of shows you what, you know, we have the schedule of employer contribution rates. When we draw the line underneath it in red and what's in green, this is the calculated rate based on the maximum funding period that would be allowed. And so we did, you know, these are just a couple different scenarios, but it just shows, you know, we can't be absolutely certain that it covers both those items, but we try to, what's within a reasonable certainty, you know, more likely than not, are we gonna meet that? So, yeah, when the increase was being baked in, it was really for those two items. It was a plan change in the assumed rate of return, and also what is the possibility of there being, you know, some adverse experience going forward. So this is 18. This is the slide we pulled from 2018. And if we go to slide 15, how would it look today? We're almost to the end of the trajectory, and you can see the gap, this gap between, you know, what's the scheduled rate versus a calculated rate based on maximum funding periods. You're starting to get additional cushion or additional margin in there to, you can weather some more adverse experience. And you know, you see a lot of scenario 5B. 5B was one that the legislators kind of latched onto in terms of for modeling purposes. All right, we go to the next slide, 16. We do some what-if scenarios. You know, what in terms of the employer contribution rate. So on the top side, you know, how bad would bad look before there would need to be an increase in the contribution rate that's currently scheduled. And so you can see it as just another way to illustrate. You've got quite a bit of margin built in to weather some adverse experience. And then on the plus side, on the bottom side, all right, what would it take to get 100% funded? What would the returns have, you know, look like within reason to achieve 100% funded over a time period? And you can see what those are. Next slide.
Yeah, so one of the things we started doing the last few years is trying to put some probabilities around these things, because as you well know, that, you know, these lines don't go straight, and you can't just use a straight line of projection and think, well, that's exactly what's going to happen. And so you also have to be very careful with these probabilities, because there's a lot of assumptions that go into them, and someone else can come up with a different set of assumptions and come up with a different probability. So what we're looking at is, just like all the rest of our numbers, trends become more important, and relative differences become more important than the actual values. But there's just some pretty simple questions that we're just monitoring, just to kind of another way to look at the health and how we're progressing. Now, we haven't excluded these, so what you're getting is that volatile market conditions showing up in these probabilities. And so you've got the 2020 valuation, 2021, and 2022, all three sets on the same actuarial assumptions. So there's no variance there. It's truly just where the market value is compared to the liability each year. And so just probability that we're over 80% by 2030 is not really ever expected. But what was interesting in 2021, that big year in the returns actually pushed it up so that very well was in play. The pullback this year, made that a little bit less likely, but it still is in the range. Now 90% by 2040, that's actually, more than expected there. And you can see that there wasn't near as much change from 2021 to 2022 in that probability. The probability of unfunded liability is smaller, 5 years out, because that's something we're really wanting to see. We're wanting to see that unfunded liability getting smaller. Still a strong probability of 63%, but it did pull back from last year's very strong probability, 78%. But a lot of that was because we had so many deferred gains. We had to basically lose all those to not get smaller in the 2021 valuation. Same thing for 10 years out, good probability that we expect the unfunded to begin to come down. And then the last one is, okay, what's the likelihood that we ever need more than the 1856? And you can see that that's around that 20% mark. It was 17% last year, about 22% based on these probabilities. And these distributions get pretty wide. So, but again, pretty low probabilities there. Pretty good bet that the unfunded liability is going to get smaller, and we're not going to need more than the 1856 at this point. But we just kind of wanted to bring these up to kind of give a little bit more of a, bigger picture view of some of this going forward.
Joe, can I ask, at the bottom of the page, we're looking at the 14.8% standardized or standard deviation annual.
Yeah.
We just got a reappraisal of the risk in our portfolio as being lower than that. Is this something offline we can run with the lower volatility projection?
Oh, yeah.
I'd be curious to see the sensitivity of that, the last line to that.
Yeah, for sure. We could rerun it. I actually purposely tried not to change those too much. So that 14.8's been the same all 3 years. That way it's trying to keep as much apples to apples as possible. But
sure.
But yeah, for sure. You tell me what standard deviation you want. It's not a big deal to update.
12.
Yeah.
Thanks.
So,
we'll talk afterwards.
And in real life, multiple period standard deviations are much lower, right? So, if you assume these annual standard deviations stay in place, the distributions are probably way wider than reality should be. So, but yeah, you let me know. We'll run it.
Yeah. To be clear, this is a good way to do it. I'm wanting to see it two ways. So, thank you.
Yeah. Okay.
My only comment to this, to add on to what Joe said, is, as I mentioned early on in the presentation, if you look at over a 2-year period from 2020 to 2022, every metric looks to be in a better spot.
Yeah, good point.
If we go to slide, actually go to the next slide and jump in one more. It's actually the last one. We'll conclude our presentation on this, but it's the similar information for PORs. It's a similar size story, type stories, SCRS, just different magnitude of the liabilities and the funding period. So, but, for completeness, want to include PORs as well.
Right.
With that, we open up to any discussion items or questions.
Questions for our actuaries? Okay, hearing none. Joe and Danny, thank you for your presentation. There's a lot of good stuff in here.
Thank you, sir.
Thank you. Thank you, guys.
All right. Next up on the agenda, we're going to recognize Jeff Berg again, and he's going to give us his delegated investment report.
The slide is on the screen. We closed 5 new investments since the last update on this. You've seen materials, but as always, Brian Moore would be very enthusiastic if you asked very difficult and detailed questions of him about any one of these.
Questions for Mr. Moore? Hearing none, please proceed.
What's the exchange rate on the euro?
$1.06 roughly today.
Okay, thank you.
Somebody should fact check that. I did look recently, so.
Give it to Mr. Moore.
Yeah, sounded more confident, I think, than I probably should. Am I close?
I know it was close,
What is it?
I wasn't sure.
That must pain you to say. So, all right. So, Mr. Chairman, that concludes the delegated investment report.
All right, so next up on our agenda is for us to recede into executive session. Mr. CEO, I'm gonna defer to you as to the timing of this. Off the cuff, I'm thinking maybe we go ahead and do it, and then we break from, come out, eat lunch, and then maybe go back in, or how
I
do
think
you?
we can probably we can receive lunch and eat while we're getting some of the presentations, I think, so let's just.
All right.
I think you just go in and stay in, I think, until.
Okay, well then do me a favor, please, and then read the motion for us.
Thank you, Mr. Chair. Motion to recede into executive session to discuss investment matters pursuant to SC Code Sections 916-80 and 916-320, including a comprehensive review of the bonds portfolio performance and a discussion of various underlying holdings and a review of potential investments in the due diligence process, to discuss personnel matters and to receive advice from legal counsel pursuant to SC Code Section 30-4-70A1 through 2.
May I have a motion to that effect, please? I have a motion, may I have a second?
Second.
I have a motion and a second. Any discussion? I'll call the vote. All in favor of receding into executive session, please do so by signifying aye.
Aye.
Any opposed? We are now in executive session. Staff, please take appropriate measures.